Thank you guys for taking some time out also to be here with me. Some time on a Saturday. I appreciate you guys. So, without any further ado, we'll get going here, and I will be talking about trading. This is a picture of me, just so you can put a name to the face, and kind of get to know me a little better. I have been with Pristine for longer than 8 years, but I've been as far as a trained trader and instructor. Going on closer to 9 years now, but I've been with Pristine, like I said, for a lot longer than that because my father, Greg Capra, actually is the founder of Pristine. So, I went through college, did the whole thing, graduated, but I knew what the markets have to offer, and I just jumped right in. I actually started trading the futures market initially, and since then I've gravitated and moved over to Forex. I think that it's, as we'll talk about, I think it's really a nice blend of what it offers in terms of its advantages, but also it's not as much as equities. With equities, there's a tremendous amount of things that you can scan and be looking at, and that's it's good in one sense, having this just absolute have your choice, pick of the litter kind of options to choose from with equities. But on the other hand, sometimes that's overwhelming. Where do I pick from? What do I choose? How do I figure out what the best of the best is? So, it's a catch-22 where too much of a good thing isn't so good. And that's where I think Forex really brings it all together, because with futures, it was almost like you didn't have enough to choose from. So Forex bridges the gap between the two, because I look at 24 different pairs each and every single day. Those are the things I'm going to trade, and I know they're going to move. I know I'm going to get opportunity, and so that's where my focus is. So that's a little bit about me, and obviously we'll talk more about Forex and just trading in general as we go on through here. But also know that what I'm going to speak to you guys about today is not something that is just specific to Forex. The way in which we at Pristine approach trading can be applied to anything out there. So if you are trading futures, if you are trading equities, you can, as I said, apply it to any of those vehicles. Because this is just, it's an objective approach. That's what we do. We're going to read price action to tell us what to do. All right? So before we get into all the meat and potatoes of everything, just our standard disclaimer: it is possible to lose money trading. If you don't know that yet, I can promise you one thing: you will find out. You will lose money. That is part of trading. Losses are part of trading, but of course it's about keeping those losses small and being able to maximize the gains, the reward. That's what we look to do, and one of the only ways to do that is, getting an education. And that's why you guys are here, is to get some level of an education, hear what's out there, and see if something kind of fits within your personality type and within what your experience has been, to the degree that you've had experience trading. And one other thing that I will say, just in general, not necessarily related to Pristine, but just in general for you guys, don't try and bounce from one method to another. Listen to what every speaker has to say and find the one that resonates best with you. And that may not be me. I mean, I'm not going to sit here and say that everybody's going to, love the Pristine method and it's going to be their thing. I think trading is much more about individuals finding someone that they can connect with, finding a method that they can connect with and make work for them. So just keep that in mind. It's not about trying to cherry pick what this guy is doing and what that guy is doing and this person. It's about taking what someone is saying, right, and making it your own. Okay, so and that's what we really do. I mean, at Pristine, we give you the tools, we give you the objective approach, and then you can apply it to any time frame you want. All right. So why trade Forex? Well, I already got into it to some degree, but the liquidity is second to none. I mean, nothing comes close. It is by far the most liquid market in the world. Okay, and just to put that in perspective for you, let's look at a little graph here in terms of daily transactions in the billions of dollars. The U.S. stock market does $191 billion in daily transactions, which is, of course, an incredible amount of money. But that is small relative to what the futures market does. The futures market does $437 billion in daily transactions. So, again, an incredible sum of money, but larger than what the U.S. stock market's capable of. When it comes to Forex, however, you're talking $5 trillion. Trillion with a T. So, I mean, it is just absolutely dwarfing what you see there to the left. I mean, it doesn't even come close. So that, again, speaks to the liquidity that the Forex market offers. And, of course, that is a huge advantage because no matter where you are, no matter what time of day or night it is, you will get filled where you want, when you want. No questions asked. Assuming you're trading, you know, some of the more prominent pairs, US dollar pairs, the major cross pairs, things like that, you will not have any issue getting filled where you want, when you want. Okay? And to that end, it is a 24-hour market, so in a sense, there's constant movement. Now, it does close for a short period of time over the weekend, so it's not open right now, but will be opening again tomorrow. But this 24-hour market is just a constant flow of movement. It constantly offers opportunity. And sometimes those opportunities come in the form of actionable trades, and other times those opportunities are just things that are setting up. Right? Not necessarily something you're going to take action on right now, but one of the things that I'll look to do in the evening is I'll say, okay, you know, what is setting up in these overnight hours that may trigger when the London session gets going? And I'll set orders overnight to just, you know, sit there, and if they trigger, great. I'll wake up and either be in a trade, maybe have taken a profit, you know, in some cases have been stopped out. It does happen. I mean, it is trading, right? So there are constant opportunities coming to you. It just depends on the time of day. Now, the fact that it's a 24-hour market also means a couple other things as well. First of all, if you maybe work another job, maybe you're on the you know, West Coast and you want to be up early because you have to get to work in the morning, but you want to trade a little bit too. So how do you do that? Well, finding a 24-hour market would bridge the gap. So it's very accommodating to one's schedule. And not only that, the fact that it's a 24-hour market, guys, what does that mean in terms of price action? In other words, and I'm asking you guys for a little participation here, what will you not see with Forex charts that you will see with equity charts? Exactly, right? Gaps. So it makes for much more seamless price action. And so if you've ever heard that Forex tends to trend really well, that's true because it doesn't get disrupted by the gap. Now, I'm not saying that it's always trending. I mean, well, I guess I could say anything is always trending. It's just a question of whether it's going up, down, or sideways, and for how long is that trend lasting. But be that as it may, the fact that you have this 24-hour flow of data that's not disrupted by any gaps, it does lend itself to much better follow-through overall, and for that reason I like to trade off of larger time frames. I like to look at the hourly chart and the 4-hour chart, for example. you can trade Forex off of, say, 5 and 15-minute charts, but you're probably not going to be able to capture the amount of move that you would if you were on the larger time frames, and that's fine. That again speaks to what is your personality type. What are you looking to do? Are you a more patient person, in which case you would be on the larger time frames, or are you somebody who needs the action, needs to be in and out more quickly, in which case you'd be on the smaller time frames? So again, it really is up to you in terms of what time frame you want to trade from. This method that we're talking about and that we will get into a bit more works with any time frame. All right. Now, in addition to those two things, Forex also offers a lower cost, a lower barrier to entry. Typically, there's no commissions as it's built into the spread. And in addition to that, you don't have to have a $25,000 account minimum. I mean, you can get started with very small amount of capital, and you can get some really high leverage. Now, I'm not suggesting you go out and use all of the leverage that you can get, because it is a double-edged sword. It's something you have to respect. But look, if you start with a relatively small amount of capital, whatever that may be for you, and you slowly build it up, that leverage becomes something that you can really take advantage of. All right? So just know that it is out there for you. There's also no platform fees or data fees or exchange fees, a lot of things that as an equity trader you do have to incur as a cost of doing business, right? So I mean, just think about how much you spend in fees on a daily basis, on a monthly basis, whatever the case is, when trading equities, and just wipe those out. Get rid of them, right? So again, you know, it really reduces the overhead and puts that right into your bottom line. Let me just see this question here. How many people blew up account on the Swiss move last year? You know, I don't know the exact number, but a lot of people. I mean, look at FXCM basically having to get bailed out. I believe it was Alpari went bankrupt because of it. So there were a lot of people that got, you know, caught with their pants down basically, and you know, that's why you need to be objective. That's why you need to have an approach that removes the emotion and gives you this way of thinking that really removes, as I just said, the emotion and you know, all of the noise that you can see and feel using subjective tools, right? You don't have to worry about. And yeah, exactly, you know, following up on what I was saying about leverage, that's exactly what your point was also. Yeah, I mean, having that leverage is a double-edged sword. So it's nice to know it's there, but you gotta get comfortable and confident with your method first, and then you can start increasing, you know, your size, because the leverage you have will allow you to do that. So absolutely, good point. Right. Now, do you really need these tools? Do you really need, you know, because now this isn't to say that it's only used in Forex. I mean, a lot of traders use some or all of these tools with equities too, but with Forex, you know, you hear that you need to have fib retracements, you need to have MACD, RSI, Bollinger Band, whatever, you know, the list goes on and on. Do you really need these? What do you guys think? Do you really need these? You know, Forex.com, Lewis, is a really good broker. You could go to Forex.com. There are some others out there, but Forex.com is probably one of the top ones out there, or Gain Capital, which is basically the parent of Forex.com. So I would check them out. FXM charges commissions, but clean. Yeah, you know, everybody's kind of got their different thing that they do. So you know, you just shop around, see what you can get, see what's out there. So I mean, do you really need these? In my opinion, no. Now, some people may say yes, some people may feel, at least right now, that you do need these. And what I hope to do over the time that we have here today is at least, if nothing more, make you question a little harder, do you really need these? I mean, really, do you need these to make decisions? Do you need these to be successful? Hopefully by the end of this presentation, you're going to say, hey, you know what? I don't think you do. I think Kurt's onto something there with not needing all of this noise and subjectivity. But you know what? If I can't get you there, hopefully, like I said, I can at least get you questioning that maybe I need to look at price a little closer, because the bottom line is all of these things are based on price. Right? All of these things are based on price. Forex is not really regulated, not to the degree that you have with equities, because it's a world market. So, you know, who's really going to take control? And so I think that is another advantage, that it's not necessarily regulated in that way. Now, I mean, you know, there are rules that brokers have to follow. I mean, it's not like a free-for-all, but it's certainly not as tight as FX or I'm sorry, with equities. And yeah, taxes, absolutely, still need to pay taxes, of course. Absolutely. You know, so what ends up happening is you hear that you need this tool, you need that tool, you need the fibs, you need the Bollinger Band, you need the MACD, etc. You end up looking at a chart that seems something similar to this. And you know, you're thinking, how can I go wrong? Well, I can think of many reasons how you can go wrong looking at this, because what ends up happening, guys, is you put this tool on, you put that tool on, you end up with a chart that looks like this, and then you're making decisions based on everything other than price. Right? You're making decisions based on everything other than price. So this is not what, in my opinion, you want to be doing. This is not any type of objective approach to trading. This, if anything, to me, is just going to confuse you. So I would say strip it all down and focus just simply on price, because that's what matters. Price, multiple time frames, understanding price support and resistance. You know, and when I say price support and resistance, I'm not talking about fib retracements. I'm not talking about moving averages. I'm talking about price data, where traders have put their money in the past and where they're likely going to act in the future, right? Because that's what we really have to embrace here, is the idea, the fact that we are trading against one another, and we all experience emotions in the same way. So if I know that, hey, we're coming back down to retest an area where traders had gotten on board and made money in the past, the odds are pretty strong that those traders and new traders are going to look to take a similar action here again. And if the larger time frame is still in my favor, and the other amplifiers that I look for are still in my favor, then the odds are in my favor for a successful trade. And that's what we're really looking to do, not just at Pristine, but any method, any approach to trading is looking to put the odds in your favor. The question is, how do you do that? How do you go about doing it? And everybody's got their own approach, their own way of saying, hey, this is how I have my edge. But like I said, you need to be considering not just on the time frame you're looking at, but at least on the next larger time frame. Where are the moving averages? Where's the support and resistance? How do I know when a trend is beginning to change? How do I understand candlestick language? These things are vital to your success. Because if I can read the human emotion based on the charts, based on the candlesticks, I don't need anything else to tell me what's already right here in front of my face. Okay? So this is what I want you to be working towards. This is, in my opinion, the way to focus on the charts, the way to look at charts, the way to set your charts up. And all you have is price and two moving averages. You don't need anything else. Yeah, almost naked. I mean, because this is what everything is based on. If price didn't move, the indicators that so many say you need, the fib retracements that people say you need to be looking at in order to judge where price is going to turn, they're not going to be giving you any signals. They're going to be worthless. So if price does not move, those tools are worthless. However, if price is moving, then those tools can give you signals, but those signals will be after the fact, right? This is what you want to focus on. I use, as far as the moving averages, the 8 and 21 EMA. The 8 and 21 EMA. So as you can see, and by the way, this is the same exact chart that we just looked at on the prior slide, but now you can see so much more information. Can you guys see my arrow, my cursor? Just so when I'm pointing out certain things, I want to make sure you can. Yes, okay, perfect. So, for example, if I have all of those subjective tools, and let me go back for a second, right? Here's that chart again, and you don't see the details that you just saw on the other chart. So this is again the same exact chart. So I'm going to jump back to what we were just looking at here. And now you can see wide range bar, shocking the bullish traders. It, however, is able to hold at support. It rallies back up, but then you get a breakout failure up here. So once again, supply is pushing back. They're pushing this back down. You get a wide range bar breaking lower, and it then pierces through support. So now the trend is changing. I'd be looking at short in this area here, on this retracement, now that the trend has been broken based on my rules. I don't necessarily need to wait for the moving averages to cross. I don't need to necessarily wait for us to be below moving averages in order to take a position short. In fact, speaking of moving average crossovers, trying to trade crossovers is an after-the-fact way of trading as well, because in order for the moving average to cross, price has to be moving lower. So to that end, this moving average crossover, okay, you would have gotten short somewhere in this area here, right? Because that's what would have pulled the 8 EMA down below the 21. So the question is, where would you have put your stop? Because if you were trying to play it too tight, you would have been stopped out. Not that you were wrong in the bias, but if you were playing it too tight, if you didn't have a plan of how to place the stop or where to place the stop, that could have gotten you in trouble. As far as this time frame, this is a 4-hour chart. This is kind of like the 1-hour chart and the 4-hour chart. Lately, I've been more focused on the 1-hour time frame, but those are the two time frames that I like to be on. You can, of course, as I said earlier, trade off of a 5 or 15-minute chart as well. You just got to find what works for you, what you like best, and so that's up to you. But I will say, again, as I said earlier, it can be scary, yeah, the 5-minute. I will say that if you like the idea of trying to capture the larger moves, then the hour is going to be the place to be. Because otherwise, you're just, if you're trading a 5 or 15-minute time frame, you're going to get whipped around. It's going to happen. So if you like the idea of trying to capture the bigger move, hourly time frame, 4-hour chart, and we're going to look at examples of various trades. And if you, again, going back to just having other responsibilities. Maybe you have another job. Maybe you just don't want to sit in front of the screen all day. You can enter off of a 4-hour time frame and spend the rest of the day doing something else. You know, I mean, if you're talking about trading off of the 4-hour chart, you're really not going to be looking to do anything for the next 8 hours. It's either going to stop you out or it's going to be moving in your direction, hopefully. But you're not looking to do anything for the next several hours, so go do something else with your time. You know, go golf, go spend time with the family, do whatever you want, really, is what I'm saying. And that's one of the nice things about Forex too, is it affords you that luxury of additional time to where you're not confined to a chair in front of a screen all day. How do you pick which currency pairs to trade? Well, I have a list of 24 that I focus on every single day. So what I'll do is I'll just scan those to see where I think the best opportunity is going to be based on the patterns that we teach. And that's what I focus on. But at the same time, I will also continue to scan throughout the day those 24 pairs to see, hey, maybe based on news or whatever the reason may be, there's greater volatility in this pair that I hadn't initially flagged because, I mean, let's be honest, things change and they can change quickly. So I want to stay versatile in that sense. But as far as the currency pairs that I pick to trade, it's based on the patterns that we teach. The clear and objective method that we look at is how I make my decisions. And I really look to try and find the very best quality. So in other words, if something is really sloppy looking, if you got a bunch of overlapping candles and tails, even if you can make out a bit of a trend, I'm probably going to stay away from that. Why? Because if I try to trade within that, it's going to do a lot of damage because A, it's going to probably take forever to put any money in my pocket. I'm going to have to really just grind it out and be patient. And B, trading in that kind of grinding movement is going to, whether you realize it or not, subconsciously plant seeds of doubt in your mind. You know, I mean, for example, guys, when you get into trades, and some of you may feel this way, some of you may not, some of you may have felt this way, but you know, when you get into trades and you start to feel jittery and you start to feel nervous and you take profits too soon and you know, you don't let it get to target even though it probably will or would have when you look back on it, it's because you're trading in that whippy, sloppy environment. It's because you're putting too much pressure on yourself to where you feel like you have to be doing something. Rather than sitting back and letting things come to you, you feel you have to go out and make something happen. And so, like I said, you end up placing trades in trends that are really sloppy, and you sit there, you watch it, and it makes you real nervous. And that nervousness follows through into all other trades because you've subconsciously started to build doubt into your mind. All right, so it's extremely important that you focus on good quality trends. Just reading a question here. Yesterday, I wasn't trading yesterday. I was actually doing a little bit of travel, and I had some other responsibilities I had to take care of. But as far as why that happened, demand overwhelms supply. It's really as simple as that. It's that demand overwhelmed the existing supply, buyers stepped up, sellers went away, and price moved higher. It really doesn't have to be any more detailed than that. When you look at charts in this way, it really makes it very simple. What is the trend? Is the trend up or down? If the trend is up, we expect buyers are going to step up. But sometimes, you know, if you're not looking at multiple time frames, you can get blindsided. So in other words, if price on, say, a daily chart or a weekly chart is falling, right, you could really get in trouble. I'll give you an example, right? When the ECB and Draghi came out with their comments about how they're going to relieve their economy and the steps that they took, the euro got smashed to the downside, right? It got crushed to the downside. Where did it reverse? And you could say, oh well, it reversed when Draghi, gave his additional comments in the press conference and what have you. You can say that all you want, but if you go and look at the chart, you look at a daily chart, you'll see that it turned right at support. And I mean, it's that simple, all right? So I don't have a tremendous amount of time here. We got about 20 minutes to go, so I'm going to try and speed up through the presentation here, and I'll answer as many questions as I can. But I want to show you some examples, guys. Here's an example of U.S. dollar yen, explosive move higher, breaking out of this range. At this point, it's like, okay, buy the pullback. Right? Price pulls back. Here you can see where I got in. You can see the entry. You can see the stop loss as I was trailing it up. But you can see exactly what was being done here. Right? You see where we got in. It was actually off of an hourly chart. This is a 4-hour chart, but the entry was off of the hourly time frame down in here and riding it up. This is up 87 pips, which pips, by the way, is just the smallest incremental move that a Forex pair can make. So if you're trading a standard lot, you're up almost $1,000. If you're trading a mini lot, you're up almost $100. And as I said before, it's not so much about the money. I mean, you can make money trading no matter what it is. There's no question about that. You want to focus on the quality of the setup, because if you focus on the money, and believe me, guys, I know we're here to make money. That's why we do this. But if you focus on the will not come, or it will be very hard to obtain it. You have to focus on the quality first. You have to focus on figuring out what you want to do as far as a trader goes, and then become very confident in your approach. Once you do that, the money's going to come. And you can think about it in terms of sports. Any baseball hitter, when they're on a hitting streak, they're not thinking about anything. They're just trading. They're not trading. They're seeing the ball. They're hitting it, and it's just seamless. They're not thinking about when am I gonna move the bat back and start bringing it forward and turning my hips, etc. It's just all happening. But when they can't hit the blind side of a barn or the broad side of a barn, they're thinking about everything. Okay, so that's that. You can relate this to anything. The stop loss, it was a trailing stop at this point. So initially I had it down here, but the way that the MT4 platform works, you bring it up. You can literally drag it up, and so that's why it's above the buy point. It's just a trailing stop loss. It really wouldn't be a loss at that point. That's just the way that they kind of label it there. All right. So Forex done the pristine way is limited. It includes but is not limited to multiple time frames, trends, support and resistance, etc. Right? Like I said, I'm gonna speed up a little bit here, but you can see kind of how I look at things. So here's another example, and again, you can see entry, you can see the trail stop. You got the 8 and the 21 EMA, Aussie dollar yen. Entry down here after it pulled back. I would have liked to have gotten in down here, to be honest. That would have been the ideal place, but I saw it late. I got in here because I still liked it, and off it goes. And I mean, there are so many different ways to manage positions, but I like to keep it simple. Keep it simple, and you could do something like, hey, as long as it's above the 8 EMA, stay long. You could do something like that. I mean, you could say on a closing basis or not. That's up to you. Or you take a little bit off if it pokes below the EMA, and then trail the rest using the 21 EMA for a larger move if that's possible. There are plenty of different ways that you can manage it, or just say, you know what, I'm going to set a target wherever based on a larger time frame, and I'm going to go all or nothing. Either it hits my target or it hits my stop. One of the two is going to happen, but nothing in between. There are plenty of ways to make money, but I will again say that usually keeping it simple is best. Now, not every single one is going to work. I'm not one to sit here and say that every trade is going to work, because they don't. It's not about getting every trade to work. It's about having an objective approach that gives you an edge, that puts the odds on your side more often than not. So look, this pullback, had you bought it here, would have stopped out. It pulled back in. But let me ask you this. I mean, just because you get stopped out, will you be ready? I mean, do you when you get stopped out, know whether or not that means you were just a little early to the party, or does it mean that the trend is changing? Do you have a method of analyzing the information in a way that would give you that information? You know, I mean, because quite clearly here, this one, you were just a little early to the party. If you got stopped out and you're saying, oh, well, the trend is changing, now I'm going to start looking to get short, you miss this entire move up. But if you have an approach that will have you prepared for success, you know, it pulls back, you say, okay, well, I got stopped out here, but it's still into support to the left. I see buyers stepping up, and you look to play it higher. Now here's another example of another trade, Euro Yen, and this is again a 4-hour chart. You know, I mean, just think about it, guys. You short the breakdown, and 12, 16 hours later, you're still in the trade, you're up $1,100 or whatever it is, whatever your size is. You know, you're in this trade 16 hours later, you're up $1,100, and you didn't have to babysit it. You didn't have to sit in front of the screen constantly watching it. I mean, just think about how much you could do in 16 hours time. Think about what else you could be doing in 16 hours of your day. Plenty. You know, maybe like I said, you got another job. So you're working your other job making money, and you've got your Forex trade making you money. Whatever it is. Now, 10 misconceptions. I'm going to go through these kind of quick here because, like I said, we're running out of time. But these are some of the misconceptions out there with Forex. The bottom line, guys, is Forex is no more risky than anything else. There's a lot of, I think, bad, you know, Forex has been given a bad name. You know, you've got, it's only for professional traders, the big banks are in there playing, it's not for me. Look, I mean, I've shown you examples. I think it's safe to say I'm not a big bank. You know, I'm like any one of you guys here. So it's not any more scary than anything else. It's only scary if you don't respect it, if you don't have an education in what you're doing. But as far as the risk goes, it's no more risky than anything else. Because let me ask you something, guys. Who defines the risk? Who defines how much you're going to risk on any given trade or on any given day? And while you guys answer that, I'm going to catch up on these questions. Do you take into account fundamentals? No, I don't really look at fundamentals. I mean, you know, I'm aware of, like, for example, oil and the effect it'll have on the Canadian dollar, or gold and the effect that it'll have on Aussie dollar and New Zealand dollar pairs. So I'm aware of those intermarket relationships, but I don't necessarily let it influence the decisions that I make based on the trends that I'm seeing on that specific pair. So again, I'm aware of it, but I don't let it cloud my judgment, so to speak. And yeah, I will carry positions over the weekend if I feel strongly enough about that position, you know, continuing to trend. Absolutely will, yes. So right, exactly. You define the risk, nobody else. So if you only want to risk $100 per trade, you can do that trading equities, or you could do that trading Forex, or you could do it trading futures, whatever it is. You define the risk. So Forex is no more or less risky than anything else. You just have to understand it. Now, you can, as I said earlier, get more leverage with Forex, and so sometimes that could lead to people making stupid mistakes. But you know what? Hey, that falls under not understanding what you're dealing with. You know, so with the right education, you take the control of what's going on, of the situation. Well, we in the course that I teach for Forex, and really our other courses as well, we talk about how to predict, not necessarily predict. I'm not going to say that we predict trend changes. We just go with the flow. I mean, there are certain signals that can happen to tell us that, hey, the trend may be changing, but we're just letting price data tell us what to be doing, what to be thinking. So, you know, I mean, for example, here, this was in a downtrend. It starts to go sideways, and then you get this massive breakout. Obviously, at that point, the trend is changing. I'm going to buy the next pullback. You know, you can see these two arrows show where I got in, where I got out. The trade was closed at the time I captured this, but, you know, there's another example. This was on Euro US dollar. So we have rules as to how we define when the trend is changing and what to look for. Here's another example, US dollar, Canadian dollar. You know, some people might say, hey, this move up indicated a trend change because we moved above the moving averages. And I would respectfully have to disagree with that. Now, look, did the trend change on, say, a 5-minute chart, maybe even an hourly chart for a short period of time? Yes. On smaller time frames, it absolutely wasn't an uptrend. There's no doubt about it. And could you have made money to the long side? Of course. But this move up did nothing more than run into resistance to the left. Okay? So knowing that, you could have been looking to get short up in here, to be quite honest. I mean, so for where I got in, it was actually a bit late. But there was still enough room in this to continue moving lower that I wasn't so late, there was no opportunity to be had. Okay, so yeah, it would have been nice to get in up here. Doesn't always work out that way. How can I get on board now, though? Right? So I got in here, and you can see this red line down here. This is the take profit. This one right here is the stop loss. That's the trailing stop loss. So green line is entry. First red line down is the trail stop. Second red line down is the take profit. As far as reading US dollar, Canadian dollar, I'd read it the same way as I'd read anything else. So, you know, recently, last I got a chance to look, you know, it's been pulling back, and it's trying to find some solid ground. It's into support, been trying to stabilize. We'll see if it can't start pushing up in the next little while. Here's another example, pound yen. Tried to break down, failed, massive wide range bar up, momentum coming in, buy the breakout. Moves up into resistance, there you go. You know, take profit, or at least take part of the position. Right? At least take part of the position off up there. So, and you can see that even if you're trading relatively small size, you know, this was done on a mini lot just for purposes of showing, hey, you know, it doesn't matter what the size is. The money's there to be made, right? This move up would have yielded just over $200, and if it was a standard lot, it would have been $2,000. So, but again, I don't necessarily like talking about the money, because that's not what I feel should be your focus, especially in the beginning. Look, we're all here, as I said before, to make money. That's why we do this. But the more confident you can get in the chart patterns that you're trading, the more money you're going to make. So it's like, you know, putting the cart before the horse. You want to make money, but you're not, you know, you got to put in the time to understand the patterns, to define quality if you want to do it. So here's another one. I'm just going to show you this last one real quick. US dollar yen, shorted this up here, right? Shorted the breakdown up here, and I was just looking to play this within a sideways range. So my target would be down here, right? My target would be down here. Everybody can see this support area down here, yes? Does everybody see how this has been a support level where price has held in the past? I mean, we can all see that, right? And you can see that, by the way, without having any subjective tools on the chart. Right? So that's going to be the target, and that's where it goes. Simple as that. Nothing too you know, difficult to understand. And here's another one. I'm just, like I said, I got to speed up here. They're telling me to start wrapping it up. But another trade, pound US dollar, you know, get short right up in here. Takes a little time to get going, but eventually works its way lower. Beautiful move down. Knowing that you have the larger time frame on your side will give you the confidence to hold for larger moves. So here it is. Beautiful move lower. And here, 8 and 21 EMA, just follow it down. Keep it simple. Right? Here's the follow-up to that. You can still see the entry up here. Because the larger time frame was on my side, you know, I say, hey, let me leave a little bit of the position on the table. I don't have to have everything. I don't have to hold the whole position. You know, I definitely trimmed it down. And I said, you know what, let's see if I can't get a runner. And it went sideways a bit within here as the daily chart was pausing, but then boom, down it goes again. This is a 1 hour time frame. Right? This is a 1 hour chart. Here you can see pound, euro, pound. Right? Again, by the breakout, boom, off it goes. And here's the same chart, just following it up. Moves up, consolidates, moves up again. Trim some, take some, whatever you want to do. It's up to you. You know, I ended up leaving this position on, and I got stopped out down here when this tail popped lower. That's what took me out of this position. So I didn't get the full move up. But hey, you know what? I'm okay with that. I'm looking to get the meat out of the move. I don't concern myself with getting in at the bottom and getting out at the top. If I can get the middle chunk out of the move, I'm going to be happy with that. So here's just a breakdown of the 2 days. I teach this course. It's a 2-day course. Just so you can see the table of contents, this is the level of education that we go through, right? We talk about basic concepts. We talk about the tools for the chart. We talk about trends. Somebody was asking earlier about trends. Like I said, we spend a tremendous amount of time defining trends as well as trend changes. Our key strategies are patterns that we look to trade. We spend ample amount of time there as well. And then on day 2, we talk about support and resistance. We talk about multiple time frames. We talk about trade and money management as well as discipline. And all of these things are extremely important to one's success, as I'm sure you guys all know. Right? So with that said, guys, just this is our offer to you for being here, you know, as a thank you to spending some time this weekend with us and for participating in this investor inspiration event. If you email counselor@pristine.com with the subject investor inspiration exclusive offer, we will send you our 7 steps to a good trade ebook. Right, so if you're interested in getting that, just like I said, send that email over to counselor@pristine.com. We'll get that to you, and you know, you can begin to enjoy some additional education and insight into how we look at things. So it looks like my time is just about up here. Again, I want to thank you guys, and if I wasn't able to answer any questions, you can always email me directly. It's kurt@pristine.com. So you can, like I said, you can always email me directly there. And again, I want to thank you guys for stopping by here today. I want to thank Investor Inspiration for putting this all together for us. So, you know, I wish everyone nothing but the best success. And, you know, if I can offer you guys any kind of parting knowledge or tip, as I said, focus on getting confident in whatever you resonate with, whatever makes sense to you, whether it's what I've been talking about or somebody else. Just commit to it, get confident in it, and the money will come.